Hello, everyone. I'm Joe Pryweller, Conference Director for Plastics News. Welcome to this session of Ask the Expert, your chance to engage with professionals on a range of topics and to interact with questions. Today's Ask the Expert is sponsored by SAB Capital. Our expert is Bryan Huber, Director of the Sales-Leaseback Group at SAB Capital. Bryan will discuss how to unlock hidden value trapped in land and buildings. To submit a question, email pnevents@crane.com, or if you're watching along on LinkedIn, Facebook, or YouTube, submit your questions through those platforms. With that, I will turn things over to Bryan Huber of SAB Capital. Bryan, the floor is yours.
Hey, Joe. Thank you for the opportunity to be here today on behalf of Plastics News and Crane's business. And thank you to your team with their assistance for preparing for today's event. So really excited to be here with everyone this afternoon. And I know that we only have about 30 minutes, so why don't we dig in? So brief outline of topics that I plan to cover today. Brief overview of SAB Capital, our real estate advisory platform. A view on real estate strategy across the plastic processing industry, owning versus leasing. What is the sale-leaseback? What are some of the benefits and why plastic processors should be considering this as a real estate strategy, and some applications and case studies for how we've assisted plastic processors execute sale-leasebacks. So overview of SAB Capital. SAB Capital is a single tenant real estate brokerage, and we primarily focus on investment sales. So in terms of product type, really runs the gamut of office, retail, industrial, and then some alternative uses like in the life science space. Our process, SAB Capital is headquartered in New York, but we've transacted across 48 states in the last 12 months, completing $1 billion in transaction volume. And that runs the gamut across the entire credit spectrum. A lot of the content that you'll see on our website is more focused on an investment grade tenant audience. But where I'm particularly focused is on the sub-investment grade tenant audience. So more specifically about my coverage focus at SAB Capital with the Sale-Leaseback Group, the audience that we're really honing in on is small to medium-sized businesses and assisting those businesses access liquidity in corporately owned or corporately controlled, because sometimes these properties are held in separate property holding companies that are different than the operating business, but accessing the capital that's tied up in land and buildings to accelerate growth, fund expansion, as well as estate planning. In preparation for today's presentation, I did some research and leveraged a platform that we use in the commercial real estate industry called CoStar. And the way I would think of CoStar, it's the commercial multiple listing service. So it's a database that surveys all the commercial properties globally. And what we found was that of the 7,100 plastic processors that were surveyed on the platform, more than 52% owned their production plants outright. Owning versus leasing, 20-year view on facility ownership. So most, 52% of the plastic processors nationally own their their production plants, their real estate processing facilities, and that I think has been the customary outlook to a real estate strategy for a plastic processor. But we did some research based on the Green Street Commercial Property Price Index, and U.S. commercial properties appreciated on average 4.5% a year over the last 20 years. So therefore, if you made a $5 million investment to build a new plant, acquire an existing plant, about 20 years later, that investment would be worth approximately $12 million. However, with a leasing view and a sale-leaseback strategy, there would be an avenue to capture that $11.6 million in 2001. So I want to leave this with everyone with asking the question, as a business owner, as a CFO, if you could access that $11 million in 2001, how might you have put that capital to work to accelerate growth or support some of the corporate initiatives to scale your core business? So what is a sale-leaseback? On a 50,000 square foot level, a sale-leaseback is a transaction in which a company sells their production facility to a real estate investor who simultaneously leases back the facility to the company under a pre-approved or pre-negotiated lease. Wanted to spend some time really unpacking that and understanding the core of the concept, and I provided this visual so that the audience here has a better sense of the outcome and result here with this type of solution. So when we unpack exactly what a sale-leaseback is, it's really a solution that allows a company not in the business of owning real estate to reduce their investment in non-core or non-revenue generating assets such as land and buildings by selling this production facility to an investor who instantly leases back the property to the company. And the result after this transaction is completed is that in exchange for paying rent, the plastic processor or operating entity, in exchange for paying rent, they receive a lump sum cash payment and a lease in order to maintain their possession and day-to-day control over their facility without interrupting their business operations. So why should plastic processors consider a sale-leaseback? There's 5 primary benefits to sale-leaseback execution. I think the first and foremost is the liquidity premium. The lump sum payment that you're going to receive in exchange for selling your property to a real estate investor and leasing it back is on average 2 to 3 times greater than appraised value. Second, this vehicle unlocks capital for higher return investments, what I like to call inside the walls. So investing in people, processes, and equipment that will accelerate growth in more core business functions. Third is the flexibility to set your own terms. So you can set rent at, a market rate as low as or lower, higher, depending on your objectives with the sale-leaseback transaction. And then additionally, you don't lose any control. Generally, you can lease a property back for as little as 5 years, generally as long as 20, and then there are built-in extension options. So there's no risk that you'd ever lose control of the property itself. 4, this provides a non-dilutive source of capital and does not contain restrictive debt covenants. So relative to having to take on an equity partner, this is this capital that's tied up in land and buildings that will not dilute your current position as a shareholder in the business. And relative to typical corporate debt instruments, there are no restrictive covenants with this type of solution. And then lastly, the income taxation benefits are largely in the rent payments. So relative to having a mortgage on the property where only the interest portion of that annual debt service is deductible, the rent payment is fully tax deductible. So that provides reduction in the business's taxable income. So some case studies that I believe highlight the benefits and that we just covered on the former slide. So sale-leaseback supports investment inside the walls to grow revenue. This was a sale-leaseback transaction that we structured for a business in North Carolina, originally headquartered in the Midwest, was expanding across the Southeast. And as their footprint and presence grew across the Southeast, so did demand for their products. So as a result, SAB Cap stepped in and assisted the business with executing a 20-year sale-leaseback that generated $5 million in cash for the business. And the outcome here was that by reducing their investment in the building and reinvesting that capital inside the building, the business was able to add injection molding presses and grow revenue by 17%. So investment in people, process, and equipment to accelerate growth. This second case study that we have here is for more of an application to pay off corporate debts. So this was a business that we were supporting during early quarantine. I believe it was May, June last year, and they were having a challenging time filling orders to key customers because of some restrictive debt covenants that they had in their revolving credit facility. And they also owned about 110,000 square foot production facility in Houston. So by structuring a sale-leaseback for this particular business, they were able to generate $10 million, pay off this restrictive debt that was putting an operating restraint on their business, and use that to fill critical orders to key customers in a time where there was a lot of pressure on the supply chain globally. So sale-leasebacks can also be used as a vehicle to augment exit value. And this particular case study has 2 slides, so I'll get to the second one in a minute. But the background here was that we were supporting a family-owned manufacturer in the Northeast. They were in contract to sell their business to a multinational corporation who didn't really have any interest in acquiring the property, but had a critical need to maintain some form of possession of that property in order to continue to run the business and fulfill their investment. So SAB Capital procured a buyer who was willing to lease the property to the buyer of the business at closing. And the result here for the family was that by carving out the property and the rent multiple that they were able to earn on the property relative to the earnings multiple that they were selling the business for, allowed them to realize approximately another $5.5 million. So this profit and loss statement provides a view on how sale-leasebacks, by carving out these particular assets, land and buildings, as part of an M&A sale, or in conjunction to a family founder-owned business exiting, can assist in maximizing value, because the rent multiple that a real estate investor is willing to pay for the property in exchange for a 15 or 20-year lease is on average 2 to 3 times higher than the earnings multiple that an investor buying the operating entity may be willing to pay for the business. So I will pause there and allow us to take it back to Joe to field any questions about SAB Capital, sale-leasebacks, and our process, and how we can be assisting plastic processors access this value in their real estate footprint.
Thanks, Bryan. Terrific presentation. Enjoyed learning about sale leasebacks and how that can benefit processors. At this point, we're ready for questions. As Bryan said, you can send your questions to pnevents@crane.com, or if you're watching along on LinkedIn, Facebook, or YouTube, you can send your questions through those platforms. Bryan, let's talk a little bit about first of all, the whys of doing this. If you own a property today, why would you sell it and start paying rent on it? What are the advantages of doing that?
Sure. I think that to a lot of legacy business owners, and oftentimes it seems like, an inverse relationship. If I have complete control of the property today, why would I sell it and, want to start paying rent and add another expense to my profit and loss statement? And I think the simple answer is that I would revert back to the 20-year view on ownership. By holding that real estate over the same amount of time that you'd be leasing it back, it's only going to appreciate, by historic standards, about 4.5% a year. So if you're in the business of, processing plastics and, injection moldings, extruding, it doesn't necessarily make sense to tie up that capital in the land and building when you could be reinvesting those proceeds at a higher rate of return in equipment, machinery, people, and processes that will allow you to drive revenue and profitability and scale your business and accelerate growth.
Great. So is there a certain time in the life cycle of a company when they should do this, if they're looking at either investing in new products or new facilities or growing overseas or somewhere else, that they should look at this? Is there something that could trigger this kind of event where they might want to do a sale leaseback?
Yes. So, where I would lead with that is the last case study concurrent to exiting a business. Mm-hmm. As I outlined, this can assist with value creation and allow the shareholders of that business to realize additional value because of the multiple arbitrage in the sale-leaseback capital markets. But additionally, other applications can be used for paying down debt and creating operating flexibility. For example, similar to the business that we assisted in Houston, Texas last year. And then it can be used as, lastly, a vehicle for estate planning. Maybe you have first generation founders that are in the process of wanting to allow their children to become more inherently involved in the day-to-day business, and they're ready to, take a more passive role in the day-to-day operations because their children, have grown up in the business, but, aren't necessarily ready to sell. A sale leaseback can create a liquidity event that will allow the retiring generation, to provide them with the liquidity that they need to take a step back from the business.
Ah, great. So a lot of scenarios it can be used for, obviously. Terrific. We have a question from a viewer on LinkedIn. How can we justify the real revenue percentage globally for doing this?
So I think that, understanding the, capital that you're going to be able to realize from the sale leaseback, and having a plan of how you're going to be putting that capital to work. So if you have a new product line that you're forecasting, a 17 or 10% revenue growth, that would be, I would say, the catalyst for, pulling the trigger and executing on a sale leaseback, because what it will allow you to do is have a plan for what you're going to do with those proceeds prior to going through the exercise of selling the property and leasing it back.
Okay, great. How do you become further educated on your property sale leaseback value? Is there a process that you undergo to figure out the value of the property?
Sure. So, SAB Capital's process, the way our process works is it's a 3-step process. Number one would be an introductory call, allowing us to get acquainted with the management team, develop a firmer understanding of their business, their goals, their objectives, and then getting a better understanding of the overall size of the business, how profitable it is, where the properties are located, and how large they are, will allow our team to go back and go into the market and run a complementary valuation where we'll get a better understanding of what similar users are paying for rent on a per foot basis in that locality, and then the cap rate that the buyer audience for a sale-leaseback transaction might allocate toward that rent, and that would determine the value of the property. And then step three would be getting back on a call or a live meeting to present our valuation guidance and further refining goals and objectives to see if that there's an avenue within the business that the management team can be using to put the sale-leaseback proceeds to work.
Excellent. Do you figure out the terms too, such as the length of the lease and that kind of thing?
Yes. So generally, depending on the geographic region of the country and the overall size of the business, I would say that market will range anywhere from 15 to 20-year leases. That being said, in more core markets like New York, LA, Miami, Chicago, there may be an opportunity to structure a shorter lease term just because of the supply and demand economics associated with availability of land in those markets. There's a higher probability that if the landlord ever got the building back at the end of the lease term, they'd be able to replace that rental income stream. So that's something we provide leadership on, and what I like to consider more of a control variable. And the three variables that we're really looking at, again, are real estate fundamentals, underlying credit of the business, size, what does the balance sheet look like, and then three, the lease structure. And that's really where we're providing leadership on how to maximize value and what type of lease needs to be structured in order to achieve your proceeds objective.
Great. What happens if your space requirements change over the lease term? If you need more space, let's say, or in your plant?
Sure. No, great question. So I think this is a question that comes up frequently because 15 or 20 horizon, that's not a short amount of time, and business needs can change frequently over that lifespan. So I would say that there's two primary lease clauses that we recommend to provide operating flexibility. The first one is a lease assignment, and then the second one is going to be a sublet clause. So both of those avenues provide flexibility to allow the tenant to give back space. One happens to empower the tenant more so than the other. And I think the differentiator there is that with an assignment option, the tenant is able to be fully alleviated of their outstanding rental obligations. And so as long as they identify a replacement tenant, whereas the sublet avenue leaves the tenant responsible for the base rent. However, if they're successful in identifying replacement tenant, they're able to offset their occupancy costs in its entirety or based on a certain percentage of space that they're subletting to said user.
Great. Okay. Again, if you want to ask a question, we have a few more minutes for questions here. You can send them to pnevents@crane.com, or if you're watching along on LinkedIn, Facebook, or YouTube, you can use those platforms to send us your questions. Bryan, will properties in more densely populated geographies or regions be more valuable than properties in smaller markets?
Yeah, Joe, great question. So I think kind of relates back to what I was saying before. I think that one of the bonuses of being in a denser market will allow you to not have to commit to the property on such a long-term basis. But that being said, I would say the answer is, in simple terms, not necessarily. I think that what's critical to the buyer universe here that is buying these sale-leasebacks and supporting these businesses as a landlord partner is the activity inside the four walls, and why there's a critical need for that business to remain inside those four walls. So, you don't have to necessarily be on main and main to maximize, real estate value, sale-leaseback value. I think other consideration that these sale-leaseback investors are looking for is, what would it cost to relocate this operation? What's the book value of the equipment housed in this facility? What's unique about the labor market in this locality? And sometimes those are in, small Midwest-based markets, small Southeast-based markets. So, you don't necessarily need to be, situated or located in a densely populated area to take advantage of this solution.
Great. Good to know. A lot of plants are in rural areas or outside of the big bustling metropolis anyway.
That's right. And I would say that's where the arbitrage opportunity is most pronounced, because that's where we're going to see the most variation between the appraised value and the sale-leaseback value in smaller markets.
Here's a question that came in from email. Would an environmental site assessment and other typical due diligence assessments, such as surveys and property condition assessments, be needed before changing title to the property?
Yes, the short answer is yes. Because title will be fully transferred. The buyer audience here tends to be a professional real estate investor, and they're going to want to have the assurity that those third-party reports check out. That being said, I would say environmental issues come up on probably more than 50% of the sale-leasebacks that we're structuring. And, most of the time we are able to craft an environmental solution with an insurance policy and box out those risks for the landlord and tenant and allow everyone to successfully execute the sale-leaseback transaction and allow the business to free up that capital and allow the landlord to earn a return on the lease.
Great. So you see it more often than not in a lot of cases anyway.
Yes.
Excellent. Well, we're running out of time. Bryan, I thought I'd ask if you had any parting words, final comments you want to leave the audience with today.
Yeah, absolutely. Well, first off, Joe, thank you for setting this up on behalf of you and your team. And, what I'd like to leave the audience with is that the, sale-leaseback solution and sale-leasebacks for mid-market businesses is we're probably in the most robust market of our time. And investor demand continues to outpace supply. In 2019, the sale-leaseback market cap was approximately 19 million. And this year, the market cap is on track to do 30 billion in transaction volume. And I think that is largely driven by the demand that we're seeing for fixed income yield. When we look at the investment landscape more globally, what we're seeing is that there's a lot of volatility in the stock market and public equities, and in our fixed income security markets. Interest rates and treasury rates remain historically and highly depressed. So what we've seen is that investors are hunting for risk-adjusted yield in fixed income real estate markets, and that's created a supply constraint because of the lack of product that was delivered in 2022. Virtually delivery of new product was not delivered in Q2 and of 2020. And now with what we're seeing with material costs, primarily lumber and steel, a lot of developers are hitting the pause button on delivering new products. So with new investors in the marketplace on the demand side and a lack of supply in the marketplace, it creates the perfect storm to be a seller of U.S.-based fixed income real estate, aka sale-leasebacks.
Excellent. Well, great, Bryan. Thanks again for a terrific presentation and for really illuminating our audience on this interesting topic. It sounds like it's a great time to consider sale-leasebacks for sure if you haven't done so already. With a lot of plastics processors owning their own operations, maybe now's the time to look at that. I want to again thank SAB Capital for sponsoring this webinar. And if you have additional questions for Bryan, you can email him at bhuber@sabcap.com, and the information's on the screen there if you want to reach out to him to ask any questions or talk about a complimentary look at your property or that kind of thing. Bryan would be happy to talk to you about some of that. Today's Ask the Expert session will be available for viewing on the event site of on the events section of Plastics News website if you want to watch it again or review any portion of it. I'm Joe Pryweller with Plastics News. I'll see you at a future Ask the Expert session. Thank you.